Market technician, our tools are very limited. We can look, when we look at silver, you'll see we can compare it to how it was when it was at this price in a former time period. We cannot do that with gold because we are in uncharted territory. So this is a daily candlestick chart of spot gold, currently at 2338.87. And a few weeks ago, we talked about this flag formation, which really was a good key indication because, as you can see, once it broke above this line here, that's when we got our breakout. Now, what I've done is a basic extension. I'm starting at the lows in October up to the highs that came in December at about 2130. And then we're starting our extension from this low right here, which is just around 2000. And once we got this clear breakout, we saw that size of the candlesticks move up tremendously.
Gold has hit yet another all-time high, prompting some profit-taking. Similarly, silver is at a 2-year peak, while copper has reached a 14-month high. Gary Wagner, a technical market analyst, explains that while it's not surprising to see gold hitting new highs, it's still significant. Looking at the charts, he discusses a flag formation that indicated a breakout. It's harder to predict future movements. He points out that gold has exceeded previous resistance levels and could potentially reach $2,400 per ounce. Central banks, especially China, have been buying gold, which reduces the amount available for purchase. This, along with other economic indicators, has created a favorable environment for gold prices to rise, despite a stronger US dollar.
But the key is that huge central bank buying, and the thing about when a central bank buys is they typically don't sell. It goes into their reserves and it stays there. So it basically takes that gold out of the system for physical purchases. That's the first thing. The second thing is the expectations of rate cuts happening by the Federal Reserve as well as the ECB later on this year. Right. And then lastly is the geopolitical tension. So we've got all three things that are working, and that's what's caused the attention of large institutional buyers, large hedge funds, large money managers to enter this arena where they would typically have a much smaller stake in the game, so to speak. And so because we've got those three elements really moving gold to these record highs, what's happening is that we're getting this continuation. So this is a weekly chart we're looking at. So each of these candlesticks represents a week, and I'm going back to about 2017. But as you can see on the spot gold, this is a daily chart. So you can see what it's done really since February when it hit the low of about 2000 and hasn't looked back. 2000 to 2300, we're talking about a sizable move. Typically, a rally in gold's about 160 to 200. We're basically have doubled that at 300.
Gary explains that there are three main factors driving gold to new heights. Firstly, there's anticipation of rate cuts by central banks like the Federal Reserve and the ECB later this year. Secondly, geopolitical tensions are adding to the mix. Lastly, central banks, especially China, are buying more gold, which is taking it out of circulation and boosting its value. He notes that these factors have attracted big players like institutional buyers and hedge funds to invest heavily in gold, leading to its record-breaking rally. Looking at weekly charts, Gary shows how gold has been steadily climbing since hitting a low in February. He mentions that while China's gold buying has slowed down a bit, any slowdown in their pace could potentially trigger a market correction.
And have racked up sizable profits are looking for signs of weakness to exit the trade and bank those profits. The futures traders are, because that is typically what we're looking to do, is if we see weakness in the market to stand back. This is unprecedented territory because we typically, as I said, don't get a $300+ rally, and that's what we're seeing.
However, Gary highlights that market corrections can happen for various reasons. not just because of central bank actions. He emphasizes that the current situation is unprecedented, with gold experiencing a significant rally of over $300, which adds to the uncertainty. Gary discusses silver's recent surge to a 2-year high, highlighting key price levels on the chart. He points out that historical data makes it easier to analyze silver's market dynamics compared to gold. Currently, silver is trading around $28, with potential resistance at $31 and $32. Gary notes that if silver breaks through these levels, it could signal further upward movement.
As a market technician, is a lot easier because we have historical data. These highs here that came in 2020 and this in February 2021 came in around $31, $31.50. We're at a key level, $28 right now, $27.97. This is the most active July futures contract. And so we could see something come in at this point. And the reason being is when we look at, for example, this top here that came in at the beginning of 2022, that's what we do as market technicians. We look to see prior tops or bottoms in the market as price points or inflection points that if there is going to be weakness, we would see a pullback either here. If let's say silver breaks through here and continues to move higher, we're then wanting to look at the $30 because we had this one top here. But if it goes even higher than that, the top is about $32.50 before it starts breaking above recent records that it has had, not all-time record highs, but recent highs that we've seen in silver.
When discussing what's behind silver's rally, Gary highlights two main factors: industrial demand and investment flows. Silver is not only used for investment purposes, but also has various industrial applications, which contributes to its demand. Additionally, investment flows, including buying and selling by investors, play a significant role in influencing silver prices. Recently, there have been spikes in trading volume, indicating increased liquidity and potential price movements. These spikes suggest heightened interest in silver trading, which could be influenced by various factors such as economic news, geopolitical tensions, or changes in investor sentiment.
Well, if silver continues to rise, we have to look at the $30 level. Let me go ahead and compress a little bit. Actually, we'll turn it into a weekly because that's the way to make sense out of this data. We have to really go back to, as I said, 2020 through 2021. These three tops here at $30 is really what we want to look at before we're going to see any real resistance on a technical basis come in. And the key about these technical levels is if it's industrial demand that's driving the markets higher, then typically what we see is a much more simplistic or strong move past these price points or inflection points simply because it's demand driven rather than technically driven. A lot of times you'll see analysts talk about a market that is technically driven, or there's a technical sell-off or fundamental sell-off. And right now, the fundamentals are so strong in gold that there are people looking at this as.
In discussing the short-term forecast for silver, Gary indicates that if silver continues to rise, attention should be paid to the $30 level. He suggests analyzing historical data from 2020 through 2021, particularly focusing on the three previous tops at around $30 per ounce. Gary explains that hitting these levels would likely encounter resistance, but if driven by strong industrial demand, the market might push past them more easily. He distinguishes between demand-driven and technically driven market movements, highlighting the current strength of fundamentals supporting silver's rise. Switching gears to copper, Gary comments on its recent surge to a 14-month high. He notes the absence of clear signs of supply constraints from chart analysis. Instead, he focuses on the gap between Tuesday's closing and Wednesday's opening prices, indicating a potential area for market correction. This phenomenon, known as filling the gap, suggests a possibility of prices returning to fill in the void left by the gap.
If we look at the action today, and this really drove the market up to 815, but we have a gap that occurred between Tuesday's trading activity here and then Wednesday. A price gap is simply a void. In other words, we had copper on Tuesday close at 790 and then open at 795, and that creates a space in between these two candles. Market technicians call that filling the gap. We look for points in which a gap has occurred, which is a price void. And one theory states that typically, even in a bullish market, you can see it come back, and we call it backfilling this price point and filling that in. That's the only weakness that I'm seeing because, as you noted in the intro, volume is tremendous.
Regarding the broader commodity cycle, Gary addresses the concept of a supercycle. He recognizes that both gold and copper are experiencing what could be considered supercycles, characterized by a series of higher highs and new records. He hints at the possibility of long-term cycles, which can be analyzed using charts spanning multiple years or even decades. Gary expresses enthusiasm for discussing this topic further in future segments. Overall, Gary's insights provide a nuanced understanding of the current trends in silver, copper, and the broader commodity market. He emphasizes the importance of analyzing both technical and fundamental factors to make informed decisions about investments. If you enjoyed this breakdown, hit that like button and subscribe for more gold market analysis. In the comments below, let me know what other questions you have about gold or other precious metals.